Hi, I'm Jimmy. In this video, we're going to take a quick look at the US economy and hopefully get an idea of if it makes sense to invest during these crazy times, even though the stock market seems to be all over the place these days. Okay, so let's start with the GDP of the United States. GDP is short for gross domestic product, and basically it's the value of all the goods and services produced by a country over a specific period of time. Now, as we could imagine, COVID-19 has forced many economies around the world into a hard stop. So clearly GDP is going to get hurt by this. Now, this is a chart of real GDP going way, way back. Real just means it's after inflation. We'll come back to inflation in a moment. Now, I think that there are a couple interesting things going on right now with GDP. First, we may notice that this gradual trend lower as to the growth rate of GDP over many years now. And this actually makes sense if we think about it, because the bigger a country gets or the bigger a company gets, the tougher it is to grow at a fast rate. And we can't forget that this is the overall growth rate on an annual basis. But now let's shorten up the time period a bit and switch over to quarterly numbers. Well, now we can see a bit more detail. And clearly, the most important level for us to watch is the 0 level. Anything below that is negative growth, and anything above it is positive growth. So we can see time periods like the Great Recession, where we had multiple quarters. Each one of these dots represent a different quarter. Well, we had multiple quarters in a row of negative growth. And that's actually the technical definition of a recession. But what else struck me about this particular chart was right back here. What happened to cause one of the lowest quarterly drops since World War II? Well, what happened back then was something that they called the Asian flu, or H2N2 virus. And that hit the entire world in, I believe it was February of 1957, and it hit the US in June of 1957. And from the end of June to the end of 1957, the S&P 500 at that time was down about 15%. But there was also a spike in unemployment, a huge drop in car sales, and clearly a giant drop in GDP. Now, fast forward to today, and it's very possible that things are going to get worse than that. And clearly, GDP numbers for 2020 haven't been updated yet. And I believe the next release is at the start of next month. And that's going to represent the first quarter of 2020. And that's not going to look all that great. But the second quarter of 2020 is going to be way, way worse. It may even be worse than the 1957-1958 virus. Now, I'm sure that many people have heard that the 1918 influenza, or the Spanish flu, is the most comparable pandemic to today's coronavirus. And that seems to be true. But I went back and looked at that time period, and I found it very difficult to compare to today's time period. The 1918 influenza was intertwined with World War I, so I found it very difficult to tell what was causing the different movements in the stock market. Surely the influenza only made things worse, but I just found it really tricky to reliably compare to today. Now, I'm not sure that 1957 is the perfect comparison either. I think we're truly in a unique time period right now. I was just curious when I was doing my research what happened back then. I was surprised to see that it was a virus that helped cause some of the problems. But either way, GDP dipped big in 1957, and the virus was at least a contributing factor. Today's virus seems to be worse, and there are more economies around the world that have shut down. So I thought it made sense to bring this out, because I actually think that this reaction now to GDP is going to be worse. Now, maybe if we get lucky, we can say that it will only get as bad as it did back in the 1957 time period. But either way, it's not going to be good. So I think our first baseline assumption is that GDP is going to have a real problem in at least the short term. Okay, what about unemployment? So this is a chart of jobless claims going all the way back to the year 2000. And just to illustrate, this is the Great Recession. And these are the past few weeks. So clearly, people are losing their jobs right now at a staggering pace. Now, in the Great Recession time period, we sort of saw a gradual ramp up and then a longer gradual ramp back down. Now, I don't expect for this, from our current level, for the ramp down to be quite as gradual as it was in the Great Recession. So when we shorten this up to the past year, well, clearly, this is where the economy really went ahead and slammed on its brakes. Then companies started letting people go, and we saw over 3 million jobless claims over the past, in the first week. Oh yeah, by the way, I probably should have said this before. The y-axis here, so that y-axis is in thousands. So 3,000 is actually 3 million people. And then we have a jump of almost 7 million people that had initial jobless claims. And then in the most recent number, it came in at about 6.5 million. I actually think it was 6.6 million in the most recent week. So we're already over 16 million people that have hit the initial jobless claims. Now, where does this go from here? So let's add a few hypothetical months to this whole chart. Now, I'm making this up, but imagine I think it could look something like this. Sure, I don't have nearly enough dots on this chart, but I'm just guessing because mathematically, to me, it seems logical that we would have to have a fairly quick drop-off in the amount of new people filing for unemployment or initial jobless claims. But I think really where the question is how long do these people stay unemployed? Because this is just tracking new people. So you just sort of keep adding to it and the unemployment rate will get worse. And I think that's the most dangerous part to this whole thing. How quickly can people get their jobs back or similar jobs or better jobs or whatever it is? And clearly, the longer that takes, the worse it's going to be for the broader economy. Now, this brings us to the $2 trillion stimulus package that the US government recently put in place. Now, from an economic standpoint, the goal of that is to try to keep the economy moving, or at least gearing up to get ready to move once people are free to leave their houses and free to spend again. Now, the positive side of this stimulus package is that it should put a lot of money into the economy, which should in turn inspire more people to spend, which has the potential to at least jumpstart the economy. Now, the potential negative side to this is an increase in inflation. This is a chart of inflation going back to 1919. Now, once again, the very important level here is zero. Anything above zero is called inflation. Anything below zero is called a deflation. Now, we may have heard that the Federal Reserve and most economists want inflation to stay in the 2 to 3% range. And roughly speaking, for many years, that's about what it's been. Now, one way to get higher inflation is for the government to print a lot more money, which is exactly what they're doing with this $2 trillion stimulus package. And I've seen quite a few comments on different videos where people are saying that what could happen is that the government goes out and creates a bunch of cash, and in doing so, they create a bunch of inflation. And some people are saying that the government needs to stop. And while this is fundamentally true, yes, this could happen, inflation could happen, I actually think it's somewhat unlikely. As an example, look at what happened during the Great Recession. Here we got an example of deflation, which hadn't happened in many, many years. And deflation is typically what happens during a recession. And the government responded to the Great Recession by printing a ton of money, all the quantitative easing that happened back then. Yet inflation, even when it started getting better, or it started getting worse, I suppose, with rising inflation, it didn't get all that bad. And that's largely because of unemployment. See, when inflation happens because people go out and spend more, and the more people spend, the more prices of goods and services go up. And that's why if the government went out and printed a ton of money and everybody rushed out to spend it, well, prices would rise because the supply of those goods and services would be limited. But when we have high unemployment, it's unlikely that those unemployment people are going to rush out to spend any stimulus checks that they may get. They're more likely to be much more strategic with that money. So there isn't really room for a large spike in inflation in this particular case, because as we know, the more and more people are losing jobs at this point. Well, who's going to spend all the money that's going to ramp up inflation? Sure, some items that are crazy sought after right now, toilet paper is a good example of that. Well, those prices might see huge inflation amounts, but if we tried to book a flight for the end of this month, I'm sure they're going to be crazy cheap at this point. So once again, these are very unusual times that we're in. Overall, unemployment is spiking, GDP is going to take a big dip, and the government is trying to print a ton of money to help the economy, which is potentially dangerous. They're trying not to trigger inflation. They're trying also to avoid deflation, which would also be bad for the economy. So now the real question for us investors is, what do us investors do next? And since I'm a firm believer in long-term investing, well, I truly believe that this is a huge opportunity. So many stocks are at levels that we haven't seen for many years, and when the country recovers, and I do believe that it will recover, when it does, if that's in 1 year or 3 years or 5 years, however many years it is from now, I do believe that we're going to look back at this time and be happy that we invested during this particular chaotic time period. And since bonds are paying crazy low interest rates right now, I'm personally a fan of stocks at this time. And if you're curious, I actually did a video on how falling interest rates affect the broader economy. So if you're interested, that could be a good next video for you to watch. There's a link right here. There's a link in the description below. And I want to thank you so much for sticking with me all the way into the video. I appreciate it. Stay safe. I'll see you in the next video.